Hey, it is Troy Stavros with Cornerstone Realty Associates here in Knoxville, and I want to talk today about interest rates and buyer demand and what is happening currently in the market. So, since peaking at about 7.52% in April, the average 30-year fixed mortgage rate has gradually decreased to 6.37%, according to Mortgage News Daily, as of today. This slight drop in rates begs the question, has housing affordability improved enough to ignite the market? And the answer so far is a cautious not quite. Despite the slight dip, the Mortgage Purchase Application Index remains stuck near multi-decade lows. So why hasn't this rate decrease sparked more activity? So here are a couple perspectives. Ali Wolf, who's the chief economist at Zonda, says it seems a deflationary mindset has gripped some home shoppers. Builders report decent traffic, but many buyers are holding out, convinced that rates will fall further, so they are waiting. And Nick Timiraos, chief economics correspondent at the Wall Street Journal, adds, we might be running out of buyers who can actually afford homes given the current rate environment. Just because some markets weathered the initial impact of 7% rates doesn't mean buyers can continue to absorb these costs. They still have to qualify for monthly payments at today's rates. So, without substantial improvement in housing affordability, the recovery in existing home sales will likely be slow and steady, a marathon, not a sprint. High switching costs are keeping homeowners from selling, and many are hesitant to trade their low pre-22 rates for the much higher rates currently available. However, if affordability improves through lower mortgage rates, decreased home prices, or increased incomes, we could see a surge in market activity. Over time, life events like growing families or significant changes may nudge more homeowners to move, gradually reducing the so-called switching costs. Interestingly, while we often focus on mortgage rates and home prices, the concept of psychological affordability plays a significant role. Home buyers aren't just reacting to numbers, they're influenced by their perceptions and expectations of the future, making the timing of their decisions as much about mindset as it is about market conditions. Today, I had a conversation with a past client who found himself at a crossroads. He'd recently experienced a significant life change, and downsizing seemed like it would be the perfect solution. He imagined selling the home, pocketing some cash, and moving into a smaller home that better suited his new lifestyle. But as we dug into the numbers, an unexpected reality emerged. His current home, which began with a $360,000 mortgage at a comfortable 3.5% interest rate, carried a manageable monthly payment of about $1,616 plus taxes and insurance. His plan was to sell, downsize, and reduce his loan to $260,000, about $100,000 less. On paper, it sounded perfect. Smaller house, smaller loan, smaller payments, right? However, we then discussed the impact of today's interest rates. With the current rate, say around 6.5%, the payment on a $260,000 loan would be around $1,643 per month, nearly $27 more than what he was paying on a much larger loan. He was stunned. Despite lowering his mortgage by $100,000, he would still end up with a higher monthly payment. And not only that, over the life of the loan, he would pay over $100,000 more in interest. The weight of this realization hit hard. What seemed like a logical step, downsizing to reduce the costs, had turned into a perplexing dilemma where the numbers didn't align with expectations. It was a sobering reminder of how much the interest rate environment can impact financial decisions. The move that felt like it should save him money was actually going to cost more every month and way more over the life of the loan if he chose to stay in the house. The reality was that his low 3.5% rate had been an anchor, keeping his payments low even on a large loan. Letting go of that rate, even for a smaller home, would mean accepting a higher monthly burden. This conversation became more about just numbers. it became about reevaluating what downsizing really meant for him, financially, emotionally, and practically. He realized that the higher payment would cut into the very savings he had hoped to achieve by moving to a smaller home. We talked about alternative options, such as possibly renting out part of his current home or waiting for a more favorable market where interest rates might drop. In moments like this, it's fascinating to consider how a simple shift in perspective, viewing a mortgage not as a financial tool but as a strategic asset, can drastically alter life decisions. This client's situation is a perfect example of how interest rates can quietly and profoundly influence our paths. I hope this has been educational. If you have any questions about this or about anything real estate related, don't hesitate to reach out to me. This is Troy Stavros with Cornerstone Realty Associates here in Knoxville.